Hi folks, how you doing? Here's a couple of problems. So these problems are from chapter 13. They were not assigned as your homework. They're basically a bit more difficult, okay? But I thought, if you have some time, trying to understand a little bit better, thought I'd go through some of these. We don't have a tax return to do this week. So I thought I'd go through some of these. I think it might, for those of you that are online, I think it might be a bit more helpful than trying to watch those WebEx videos. So anyway, let's take a look here. Okay, a couple problems. All right, so first problem here, it says we got Jacqueline. She's not married. She's 32 years old. Okay, and she's in a retirement plan from her employer. Okay, it's important to know. Let's see here. This one, let's try that. Okay, anyway, so she contributed $3,000 to a traditional IRA. Traditional. This traditional here means it's a deduction. Ooh, that's too fat. Okay, so she gets to take a deduction. So it's not taxable. So in other words, she's going to get it as a deduction now, but it's going to be taxed later. Okay? All right. So she's head of household, and it said her AGI, that's the adjusted gross income, is 43. And they want to know what is the after-tax cost. So the bottom line is that Jacqueline puts in $3,000. She puts in $3,000, but what does she save? Okay, oops, but how much does she save? So what they're getting at, does she save? So what they're getting at here is that, yes, Jessica is going to take $3,000 out of her pocket, but she's going to get some tax breaks that are going to make up part of it. Okay, so here's how it works. Okay, so notice, because her MAGI does not exceed $77,000, she's allowed to deduct the $3,000 in full from her AGI. Okay, right? She's in the 12% tax bracket. So $3,000 by 12%, this is $360. So although she spends $3,000, she saves $360, bringing the net cost down. Then, based upon her income, with her AGI of 40, she also gets what's called a 10% credit on $2,000. This is a saver's credit. Oops. Well, what's going on here? Savers credit. And again, this is for low to low mid-income folks. And what they do, if you're investing, putting away money for retirement, the government gets you a break, and it's on $2,000 of that. So 10% times 2,000 is another $200. So she'll save $560. So although out of pocket is $3,000, net is only going to be $2,440 because she saves $560. So maybe it's pretty good. If you look, $2,440, it's almost 20%. Okay, so yes, she has to put in $3,000. Fortunately, she has that. But the net effect is she's going to save $560 in tax by investing that. 20% return is pretty good on your money. Okay, that's the first one. Okay. Now, next one, this is number 2. It says Ian retired in December 2024. He's 73. Okay. His retirement account is $500,000 at the end of 2023. He has had all of his retirement accounts open for 15 years. Remember, there's a stipulation about 5 years, things like this. So they want to know, what is the required minimum distribution for 2024? So he retired in 2023. Okay? So they want to know what's the percentage. Now, notice this exhibit right here. Well, let's see if this exhibit thing works. Control, click. Let's see if it'll work. Control, click. Skip verification. So hopefully this, here you go. So here's the age. This is a partial. So you see the age of the participant. So he's, what did they say he was? I think he was 73. Hang on. He is, how old is he? He's 73. At the age of 73, his birthday is January 6th. And they said down here that he's going to wind up using 3.77. Okay, let's go back to this other item here. So see this 73, see this right here? 73, distribution period. You don't have to worry about that. That's an estimation on life. Applicable percentage. See that 3.77? So all you need to do is go back over here. Okay, right? And you're going to use that percentage. So what's going to happen? Notice he's got $500,000. See this right here, that 500,000? 500,000 times 3.77%. Okay, and what that's going to be is, if you look here, 500,000 times 3.77. So his minimum distribution, to answer the question, this is the minimum distribution right here. Now the question is, when does he have to take it by? Okay, so remember, this is the end of 2024, right? All right, so he has until April 1st, 2025, basically the next year to take it. Okay, so that's the first. So it's asking basically, so the first one is, what's the required minimum distribution? And then the second one, what is it from a Roth 401k? Well, in a Roth, there is no, notice right here, there's no required. Why? Already paid tax. Okay, so those required distributions have to do with collecting tax. Okay, now the next one, it says, what about from a traditional IRA? Well, traditional, they still want that they want their tax money. So anytime you have not been taxed, there is a required minimum distribution, and it's based upon the age. Okay, so the same thing here, the same 3.77%. What about if it was a Roth? Again, if it was a Roth, the answer is 0. Why? Already paid the tax. So if you didn't pay the tax, so bottom line, tax later. If you pay tax later, this is the general rule. If you pay tax later, required minimum distribution. Distribution, RMD. Taxed before, no RMD. Okay? Hopefully that makes sense, because the government wants their money. All right, folks, that's 2 of the homework problems. I'll be back with some more in just a minute.